All right, let's dive into one of the most treacherous parts of tax prep, married filing separately in a community property state. This is a real minefield where state law, the federal tax code, and the IRS's automated systems are on a collision course. And, your client, who's just trying to do the right thing, is often the one caught right in the middle.
Okay, so here's our game plan. We're going to break down exactly what this trap is, get into the weeds on the state rules that create it, and then really master our main line of defense, Form 8958. After that, we'll cover the software glitches, the serious legal risks, and the audit strategies you absolutely need to know.
So first things first, let's be super clear about what this problem is. This isn't about clients making mistakes. It's really about a fundamental breakdown in how the IRS processes these returns.
Here's the bottom line. The trap exists because of a massive conflict. The law demands that your client split their community income, right? But the IRS's computer system, the Automated Under-Reporter, or AUR, it's just not built for that. It's designed to do one simple thing, match a W-2 to a single Social Security number. It's a flaw in the system that actually ends up punishing people for being compliant.
So let's walk through how this trap actually springs. It's an automated chain reaction. Your client does everything by the book. They get a $100,000 W-2, but they follow state law and report only their $50,000 share. But the AUR system? It just sees the $100,000 from the employer and the $50,000 on the 1040, and bam, it flags a discrepancy and spits out a CP 2000 notice. And just like that, the burden of proof is thrown right back on your client to prove they did everything right in the first place.
Now, to really understand how to get out of this trap, we have to understand how it's built. And the foundation really is state property law. You have got to know these rules inside and out, because if the state says your client legally owns half the income, then you better believe the IRS says they're going to be taxed on half of it.
And this, right here, is the core difference that causes the biggest mistakes. It's like two different universes. In Texas, they have this idea of income hybridity. So the fruits, think dividends, interest, from a separate asset, they're usually considered community property. But in California, it's all about pure tracing. The fruit follows the tree. Income from a separate asset stays separate. Getting this one distinction wrong is a huge compliance risk.
And this table is where the rubber meets the road. Just look at those bolded items. If your client is a Texas MFS filer, they have to split the dividends and interest from their own separate property with their spouse. A California filer? Nope, they don't. It's also really interesting that both states agree on capital gains from separate property. And this is a big one for Texas, oil and gas royalties, which stay separate. You literally have to go through every single income stream.
So, with all these tricky state rules, how in the world are we supposed to explain these splits to the IRS? Well, the answer is Form 8958. This is your #1 most important tool in this whole fight.
You should think of this form as the bridge. It connects the documents the IRS gets from employers and banks to the final numbers you put on the 1040. It is your official, legal audit trail that lays out, line by line, exactly why the number on the tax return doesn't match the W-2 or the 1099.
Now, knowing when to file this form is absolutely critical. MFS filers, obviously. But here's a huge trap. Registered domestic partners in California, Nevada, and Washington. For federal purposes, they file as single, but they still have to split community income. You can just imagine how much that confuses the IRS computers. It's also required for separated spouses who don't meet those really strict living apart rules under IRC Section 66A.
Okay, listen up, because this is a detail you absolutely cannot miss. Before the IRS computer even thinks about looking at your allocations, it's going to do one check. Does the total column on Form 8958 match the gross amount on the W-2 or 1099? If there's any mismatch at all, it's an instant red flag, and it basically makes the whole form useless.
All right, now let's get real and talk about our daily work. The very tax software we depend on can be the weakest link in this chain. It often forces us to step in and manually fix things to make sure the return is right.
So because a lot of software is just hardwired to dump W-2 info straight onto the 1040, practitioners have come up with this really clever workaround. We call it the 2W2 method. It lets you enter the real W-2 to keep the IRS computers happy, but then you use a second, offsetting entry to get to the correct net income on the return. It's basically a way to force the software to follow the law.
And this just goes to show you cannot be on autopilot. In Lacerte, you've got to wrestle with that diagnostic 6403.
With Drake, you have to use their split utility in exactly the right order, or the whole thing just breaks. And with consumer software like TurboTax, it'll often just hide the community property questions unless the user already knows they need to search for it. You have to check the output manually, every single time.
You know, getting this stuff wrong isn't just about dealing with an annoying notice. There are serious legal risks here, spelled out in the tax code and backed up by some major court cases. The stakes are high. So, you need to know about Section 66B. I call this the IRS's nuclear option. It's a penalty they can use against a spouse who tries to hide income. It lets the IRS just ignore community property law and tax 100% of that income to the person who earned it. And, importantly, a taxpayer can't use this to get out of splitting their income. It is a one-way street and it only benefits the IRS.
Now, to see just how harsh these rules can be, we have to talk about a huge case, Hardy versus Commissioner. The facts here are just brutal. A wife files her return, but she never actually received a single dime of her husband's earnings. He controlled everything. But they lived in a community property state, and she filed separately.
And the court's decision was absolutely unforgiving, and it set a major precedent. As you can see from the ruling, the court said that ownership isn't about whether you got the cash in your hand. It's a legal right that you get the second the income is earned. And your tax liability, it follows that legal ownership, not the money.
The fallout from this case is massive. It established strict liability. This means arguments like, I never got the money, or we were estranged, or even I was being financially abused. None of those are a defense against the tax bill itself. Your client is legally on the hook for tax on income they never even saw. Their only possible escape route is to file for innocent spouse relief.
So even if you prepare a flawless return, that systemic flaw in the AUR means a CP 2000 notice isn't a question of if, it's really a question of when. So, for this last section, let's put together your playbook for defending the return before it's even questioned.
For investment income, which seems to confuse the IRS computers even more than wages, this nominee strategy is incredibly powerful. It completely bypasses the Form 8958 problem. By issuing a nominee 1099, you create a perfect paper trail that the machines can follow no problem. The income matches, the deduction matches, and the spouse's income matches. It just solves the entire machine reading issue.
Okay, so when that inevitable notice hits your desk, this is your immediate action plan. Number 1, and this is the most important, do not amend the return. Amending implies you made a mistake. Instead, you send a response package. It should have a clear cover letter that cites IRC Section 66, a fresh, highlighted copy of the Form 8958, and proof, like a redacted copy of the spouse's return, that the income was actually reported. And a pro tip, always fax it. Mail can get lost in the shuffle for months.
So, to wrap it all up, here are the 4 pillars for protecting your clients. First, jurisdiction is everything. Know the difference between Texas's income hybridity and California's pure tracing cold. Second, never, ever trust your software's default settings. Third, manage your client's expectations. Tell them up front a notice is likely, and it's not their fault. And finally, remember the Hardy case. Strict liability is real, and that 50-50 split is not optional.
And I'll leave you with this final thought to chew on. As professionals, we have to master all these crazy rules and workarounds to defend our clients. But every time we do, it just highlights a massive, glaring problem in our tax administration system. So the question we have to ask is this just the price of admission for MFS filers? Or is it time for the IRS or even Congress to step in and finally fix this?